I'm going to do something really unique today. I'm actually going to open myself up and answer tax questions, preferably from non-clients, okay? So that it takes away a few of you, right, Franz? I just want to share a few things with you before I take a few questions. Donald Trump, which we obviously know is a multi-billionaire, first thing he does in the morning, he wakes up 4 o'clock every morning. First thing he does is read. And when people say that they don't have time to read, I think about a man who's a multi-billionaire. He makes time to read. He either reads a book or he does internet research. Now remember, he's worked pretty much everyone in this table did so, but he takes time to read. And when I'm talking to my clients, they want to run and do something, but they don't want to take the time to research their craft or the economic situation of their craft, or the fact of what entity they should be set up in. And what I advise my clients is business strategy, building your team. Why is your team so important? I go with an acronym called MBA, Marketing, Banker, Accountant. Most people don't know their banker's first and last name, or they don't know their loan officer's first and last name. And as a business person, we need to transcend from being an account number to being a human being. So with that said and done, if you think it's a personal question, then we'll go privately and I will ask that question one-on-one. But I'm just going to open myself up and start asking some general tax questions. Who's first? Go ahead, Russell.
Explain 1120S for me.
Oh, 1120S is subchapter S. It's an S corporation. Technically given a nickname Small Business Corp. You can technically have 100 members, 100 shareholders. Now if they marry in California community property, they count as one. So technically you can have 200. But one of the things that the IRS is cracking down off of, and this is what Russell wants me to allude to, is that if you're not on payroll, then technically speaking, your dividend or your net income can be subject to recharacterized as W-2. So, for example, if you make $200,000 of income, your expenses are $100,000, your net income, your dividend is $100,000. That can be subject to those nasty acronyms, FICA, Medicare, federal withholding, state withholding, SDI, plus this federal state expenditures as well too. So you are supposed to put yourself on payroll. Nice plug, Russell. Yes,
is there a limited or unlimited amount that you can pay yourself as an S corporation?
it's your company. There's no limitations.
So say for example, if I may follow up, say for example, you're a small business, you're just starting out, and you're bankrolling the whole thing yourself. Technically, you're living off your wife or your husband. Can I pay myself or yourself $1?
In that case, that's a little bit different, and that's a good point. I advise my clients to draft up a no payroll agreement. Some people go to the point where you can get it notarized. I can't go that far, but some people do. Because you don't have to pay yourself until the company reimburses you back your initial capital and money. My advice is, and don't quote me on this, I look at companies that are probably less than $100,000 a year. You may put yourself on payroll maybe for $10,000 to $20,000. The company is not, it doesn't have enough money to legitimately pay. But companies that are $125,000 to $150,000 plus, you should put yourself on payroll. Because you got to keep this in mind. Big Brother's broke. Big Brother's auditing. I just spent 2 hours of my morning in an IRS audit, which is finally over with. And it started last August. Since this is being filmed, my clients have a favorable situation. She may look at this and I will not repeat anything else. Yes, Mr. Davenport.
You sure you want to open it up for questions?
Yes, I do.
Okay. Can you tell us what are some of the tax advantages of life insurance policy?
Tax advantages of life insurance policy. Let's look at it in 2 parts. Let's say that you are a business owner, meaning by corporation. So when I'm saying business owner, I'm looking at corporations. You can have key man insurance. Key man's insurance, that gives the company the ability to insure themselves. But before I go in and answer your question, I want to go explain something first. If someone is married and a partner or the shareholder is not married, I do recommend for them to get an agreement that basically they enter in, and the realtors will understand this, as a married person doing business as a single person. And that's one of the purposes, the reason why I recommend key man's insurance. Because if the equity builds up in 10 years, it's $500,000, that surviving spouse will get two options. They can get part of the insurance, of all of the insurance, or may have the ability to turn down the insurance for the opportunity to be a partner or shareholder in the entity as a result of that, if that's agreed upon. Another advantage of life insurance, and you realtors will love this because I've seen it happen a few times, where primarily doctors and lawyers take advantage of this. When you have life surrender value, they borrow the money for, let's say, 3 to 6 months. They go out and purchase real estate. I won't use the common language, flipping, we call it a dealer. You go out, you rehab the property, and then you sell it. That gives you enough time to sell it, get your proceeds back, put the money back into your life insurance policy, and it's essentially tax-free. And going to another level of insurance, now you have to have a few commas to understand this, because this is only certain clients can do this. There's something called a self-directed pension plan that is lethal from the investor side of it. You literally can go from a non-traditional route in retirement. As a result of that, you can purchase a property through your Roth IRA, through your LLC. I won't go into the particulars because we all be asleep. But within that, for clients who do not want to go into a non-traditional role of investing or retirement, want to get away from Wall Street, let's say, for example, they buy the property at $100,000. 10 years later, they sell it, $500,000. We won't go into the selling expense, but the gain of it is $400,000. That is tax-free because the proceeds go into the Roth IRA. And it's perfectly legal. But usually most people are not aware of that. There are other structures within the life insurance policy that as a business owner, and Sean will know more about the product name, but as a business owner, you can actually set up a retirement plan where you, let's say you make an agreement to put in $100,000 a year. And that's the reason why I'm saying the company has to make a substantial dollar amount. Within that $100,000 a year, as the business owner, 90% or 89 point something goes to the business owner. The other 10% goes to the staff people. You, the business owners, determine the initial time frame. In other words, is it 3 years or 5 years when a person gets fully vested? If that person doesn't stay for 5 years in this example, those monies goes right back to the owner. But here's the key about this. We're coming up on tax season right now.
Does the owner have to abide those same laws, those same rules as well?
Say again?
Does the
No,
owner,
no.
yeah.
No, that's the advantage of being an owner as a result of it, because technically it's your money, sir.
Okay.
Here's the advantage of this. As long as you file an extension, once again, we're talking about corporations in this example, your tax returns are due September 15th. You can put in $100,000 September 12th, in this case, the tax year 2012, and it's a tax write-off for tax year 2011. So there are creative ways of taking advantage of this as a result of this. Yes, sir.
Are you talking about a self-directed IRA?
Say again?
You're talking about like a self-directed IRA?
No, I can't remember the name of it. It's a long name. Sean, do you know the official name of it?
Which one?
Of what I was just talking about. I can't remember.
There's a couple.
There's a couple. And let me get, because the reason why I'm saying, we're meeting
Sit
up
down
with
with me
Jim
afterward.
that specializes in that. Yes, Fred.
When you were referring to the not the self-directed IRA, but the question related to what realtors might do. If, say, for example, you don't want to do the traditional IRA or and you say you sell your house, you take the profits and you drop them into your IRA, and you say that is essentially tax-free.
Because it's a Roth IRA. Yes,
Now,
sir.
because it's in the Roth, I'll be taxed later on that, is that correct?
Yes.
It's just tax-free for the moment,
Good,
deferred
right,
tax.
but here's the old saying, do you want to be taxed on the seeds or do you want to be taxed on the crop? You'd rather be taxed on the, but see, here's the thing, in a Roth IRA, you paying taxes now because it's after-tax money.
Right.
So when you get to retirement age, that money is tax-free. That's the advantage of a Roth IRA. Okay? Lily, you got a question?
Well, I remember every January, the news reporters come out with all these new laws and tax things. Is there anything new that the majority of us small business people coming January 1st, that's going to probably affect our businesses?
In a whole, and this is a personal preference. When I look at all the new tax regulations, that's really hype to get you to come and talk to someone so they can kind of milk you out a few extra dollars. And that's my personal opinion about that. The reason why I'm saying this, my clientele who are truly affected by the tax laws are my clientele who makes several $1 million a year. And with Congress being, United States being broke, one of the things that we don't know is what are the potential new laws that are coming out there. One law, I mean, this is over 10 years, there's been a rumor, it may not be a rumor anymore now, that if you own an S corporation, your net income or your dividend may be subject to self-employment taxes. So as a result of that, we're going to, for my clientele, obviously, majority of them are not going to be S corporations anymore. So we're already taking strategies to find out should there be a limited partnership or possibly a C corporation as a result of this. And most people want to know the difference between an S corp and a C corp. S corp, for most of the clients, if your net income is roughly less than $100,000 a year, I recommend for you to get an S corp. But for my C corp clients, their taxable income is greater than $200,000, $300,000 a year. So from a tax side of it, it's cheaper to be a C corp than it is to be an S corp. Because if you have $300,000 that goes into your personal income tax, passes through, that's 35% taxes that you're paying. So you look at 300,000, that's 35,000, 35,000, 35,000. That's $105,000 you just gave away. And it's cheaper than a C corporation. Yes, Kathy?
Question about the difference between the tax ramifications between a short sale and a foreclosure.
Wow.
Somewhat.
Okay, that's a good question. And here's the sad thing about it. There's really, as an individual, businesses of Westerners are a little bit different. They fall into different tax guidelines. As an individual, there's really no difference between the two from a tax side of it. Now, when I'm saying that, as long as you stayed in your home for like 2 years and you met those rules, you can actually, if you individual, you have a $250,000 exclusion. If you married, you have a $500,000 exclusion. So you actually can walk away without having to pay any capital gains tax as a result of this. And then if you buy a house within the next 2 years, and it can't, okay. Then, but the main thing that affects that from that side of it, and this falls more in the King's area, is really the credit. But short term, they're essentially the same. The long term, obviously the foreclosure hurt you worse than a short sale. Yes, Liz?
What about the relief of debt?
Say again?
The relief of debt?
Relief of debt.
Yes, because of the short sale.
Now, the relief of debt, that depends upon whether or not they refinance. So if they refinance, and this is what they mean by relief of debt. I'm being taped. We call it boot. We have a nickname that I won't say. Put a Y next to it. That's the name. Essentially, when you have, if a person has refinanced, let's put an example, they bought a house for $100,000. Let's say $500,000. It's now worth $300,000, but they refinanced and took $100,000 out. That $100,000 is deemed to be boot or a gain or realized gain in that transaction. That is subject to capital gains tax. So people say, I'm taking my money out. No, because it's liability relief. Yes,
And
Franz?
1099 you too on that.
Yes, yes.
So then they will then 1099.
They will 1099, but you get 1099. There's three types of 1099s dealing with the short sale. There's a 1099A for abandonment. Then there could be a 1099S for a sale. Then there could be a 1099C for cancellation of debt. So it all depends upon which type of 1099 is how that falls in there.
Franz, before you go to Franz, I just want to elaborate on that a little in regards to the short sale actually being reported on your credit profile. It's still an eyesore. It's still a negative derogatory item that has been placed on your credit profile, even if they do forgive the debt.
Short sales are short sales.
Is the tax rate the same on all three of those?
From my side of it, yes, they are. But the treatment of them are a little bit different on the tax returns. But as far as you, the end user, you won't see a difference of it. So another example of a cancellation of debt is with credit cards. You owe $20,000, you sell for 10, you have to pay tax on $10,000. Yes, sir.
Sorry, Richard. It's been bugging me. You're talking about a SEP-IRA, right? A self-employed pension
The one you can remember.
right? The one that you can remember the
No,
name.
no.
Okay, well, I can
It
talk
has,
about that.
matter of fact, I'll text him to see if I can get a response from him. Yes, baby.
Is it the Kyoto plan?
No, no.
Um,
Can I be condescending?
Life insurance.
This, go
That
ahead.
was my question.
Okay.
What would you say, I have a lot of younger clients, what would you say the best tax advice I could pass along to them without having them all call you wrong?
Well, you know what, okay, I'm not a fan, personally, well, I'm older now, so it's a little bit different. I'm on the other side. I've never been a fan of employees. With how the market is changing, and what I mean by the market is changing, in my time frame, you can work, not have a degree, and work and go to retirement. In this current market, we have global competition. And some of y'all probably heard about the potential strike at Ralph. The union was getting ready to go on strike. Ralph said, if you go on strike on Monday, we're shutting down all stores in Southern California. So, and that's because, I do the grocery shopping, and I paid almost $5 for a loaf of bread. So I'm like, wow, I may need to get a part-time job just for the groceries. So the economic environment is so different. I advise the younger people to get the training and look at it as on-the-job training and start making their career path and starting their own business.
Like buying a franchise?
Yeah, like buying a franchise. Exactly. Exactly. So my time is up, but if you have any other questions that you would like to ask me that you think that are personal, after we finish meeting up, you can ask your questions right then and there. Thank you.
Thanks, Stephen.